Anybody listening here, if you have your money on Binance and you don't have a hardware wallet, you don't belong in the space. Get out. Shut it down, sell it, get it, right? You cannot be like, you can be using Binance. There's a lot of cool tools there and it's an interesting product. But if you're storing your fund's capital, your LP's capital on Binance in this moment, considering the range of rumors circulating, I would question the competency of that.
Hey everyone, welcome back to the podcast. It's Tommy and I'm here with Ryan Zur and Santiago Santos. We're back with another episode. We're going to start off with recent conferences we hit. We did Permissionless, we did Token 2049. Santi, why don't we start with you on conference you hit?
I went to Permissionless. It was interesting. It was in Austin. I wanted to see. I think the attendee base is probably the most diversified. You had people from government, you had companies, you had certainly crypto investors. It was happening at the same time while Token 2049. Apparently, it was 3,000 or so attendees. It didn't feel like that because the venue was so big. But you and I were on the panel of like who's still investing in crypto. You had some really interesting panels as well. I think if I were to say the biggest takeaway for me in that conference was that it felt to me that non-crypto people, particularly companies, like you had JP Morgan there, you had folks from numerous corporations that have been interested in utilizing this, PayPal and whatnot. It felt like those people were more excited about crypto than crypto natives. And it just reminded me of this happens in every cycle. Like there is a time where the skepticism and the morale within crypto people is just so high, is so low and volatile that, it was just really interesting because to see that. And I think it reflects the state of the market we're in. And it also reflects the kind of that this technology is come a long way. I don't think we're in that 2018, everyone is slapping blockchain to their public companies using blockchain in their reports, the same way that you're using AI right now to as a marketing kind of gimmick. I think the work is real, the intent and the commitment is real. We recorded a podcast with the head of JP Morgan Crypto, and they've been working on this for 6 years now, and they have so many products under the hood that they can't talk about publicly. And so, later on in the pod, we can talk about things that those corporations kind of need to see. Like privacy is huge, and until we have that, it's going to be difficult to properly have these folks operate in a public environment. But they're doing a lot of the work in anticipation that these solutions are going to be built. So that was my biggest takeaway. The morale in crypto is very low. People are fighting on Twitter all the time, but non-crypto people seem to be more optimistic about crypto, which is an interesting, point.
Yeah, I mean, I was at Permissionless with Santiago. As for takeaways, I mean, definitely saw a lot of good early stage companies, a lot of AI focused ones, a lot on ETH. I guess what I did see was just glimmers of a renewed focus on Ethereum, ZK Tech being built on Ethereum, and the ecosystem around there. Like, I mean, we didn't see a lot of other alt L1s mentioned. Didn't see a lot of a big ecosystem push there. Did see a big push by ZK Sync, Scroll, Linea, which is the ZK EVM built by Consensus. It seemed like there was just a pretty strong renewed focus there. And that kind of bleeds into the modular versus monolithic side. I think one of my favorite takeaways was Sriram from Eigenlayer, which we invested in. We had a bit of a side chat discussing modular versus monolithic, and he just continued to argue that you have to serve developers, and taking advantage of the largest ecosystem makes sense, and technicals don't exist solely in a vacuum. So he thinks that Ethereum's not the fastest or the cheapest chain, but it's at a maximalization point where it's good enough and improving technically, coupled with the largest ecosystem of value and people. And I thought that was a solid takeaway.
Yeah. So we had team members at 2049, and whenever team members go and do a conference, we try to institutionalize that knowledge and get a report. And so the report indicated that some level of surprise by all of us of how quickly the Singaporean market has come back, because Singapore prohibited Binance. Everybody had migrated to FTX, and some people got really crushed. And so Singapore was a mausoleum sort of last year at this time. Um, and so it seems to like be gaining steam and coming back strongly. There is, just 1,000 L2s flowering a lot in the optimism ecosystem. And there seems to be just this like, to your point, Tommy, this threshold of developer mindshare migrating back to ETH saying, hey, this is good enough for us to build on and be here. And thusly, we continue to see value bleed from the alt layer ones, sort of the like ETH killer generation of late 2017, 2018, while there are some really interesting novel experiments popping up. And so those were two things combined with a very cautious fundraising environment where if you're a capital allocator and you haven't delivered a DPI, comfortably above 2, then you're really like, you got a tough road ahead of you. And so we're seeing, we're seeing this sort of like filtering of the real players in capital allocation from the pretenders. And we continue to see more and more funds taking their last breath of air before shutting down. Which
Ryan,
ultimately
could you just give some color there? Like how many funds are not at that mark where they've at least returned 2x their initial investment? Like what percentage of funds just do not meet that mark?
I mean, ultimately it's a vintage question, right? If you were around prior to September 2017, you basically got there. If you launched like post that, you'd be really, you got some real challenge unless you hit some big winners. Yeah, you and I have talked about this before on pods where I'm constantly reminded that you're not that smart and luck plays such an important role in this game because timing is often really can be expressed in terms of luck. And so really it's about timing. I would say, difficult to estimate across the approximately 750 funds globally that we've had, but probably less than 50 are above 2x DPI at this point. In fact, I'd say confidently less than 50. I write LP checks into a lot of funds and less than 10% are even approaching that number.
Yep, I agree. In terms of, it's important distinction, like MOM is not DPI, right? Because, a lot of these things are liquid and get marked up, to some sort of discount, but DPI is like how much you've actually returned. And it's easier to do for venture funds, which there are plenty in crypto. There's also a liquid venture structured as hedge funds. They have a combination of liquid positions and early stage positions. So it's difficult because the DPI, unless you've redeemed, you're not getting that, right? Unlike a venture. And so a lot of funds are structured as liquid, as a hedge fund. And so, say that even you invested in like, you had, it's very frustrating because I also talk to the largest fund of funds and they always struggle with, well, so what's better? Should we invest in the next pure venture fund, 10-year commitment, or hedge fund? And that is going to invariably do early stage stuff because you want to be doing that. And the challenge there for liquid is, say that you invested in 2017, you would have been up at 1.30x or more on some funds.
Yep.
And now you're down considerably. You're maybe still up 10x actually, but that's not DPI. That's just mark to market to some sort of valuation framework for the illiquid stuff that can't be easily like liquidated. A lot of it might be locked. So that's the challenge, and both the opportunity and the challenge of crypto is that you have to kind of hit I want to redeem now, give me my money, and they're not giving you all of it. Some might have gates. So it's quite challenging, I think. Still, part of the opportunity in crypto is that, but yeah, it's difficult for those funds, especially if they have clawbacks. If you're down a lot, if you're up a lot one year and then you're down a lot the next year, you need to make up to this high watermark to then begin to collect carry, which really messes the incentives for an allocator Some of them take excessive risk to get back to that, above water, if you will, to start clipping carry. And that risk taking is very challenging. I don't know what the answer to that is, other than if I'm investing my own money to a new manager, I'd rather, given the choice of investing in a liquid fund that has been around for a while but has a really high watermark on a lot of the capital, right?
Mhm.
Versus a new manager or a new fund, new vintage, might be pure venture, I would choose that category, the new venture or the new vintage, because it's just a clean slate. And a lot of times in liquid, you don't have that clean slate. And a lot of the market also profit taking and dynamics, I think, are informed by those type of funds that are trying to kind of make it all back, or just, get above that high watermark, which you have to really clean up a lot of that stuff. And it's probably going to take a couple of years to get there. I think you saw that in the last cycle.
Yeah.
Yeah.
How do you look at this, Tommy, from an allocator's perspective as a GP?
Yeah, I mean, the one point I'd want to hit on that Santi brought up is just like how funds react in bull and bear markets. One of the worst things I think a fund to do in a bull market is to aggressively exit and reinvest capital. I don't know, Ryan, if you would disagree with this, but once you're in
Yeah,
a
I
bull
do, but
market,
I'll avoid.
yeah, all right. Maybe I should have taken the other side, but
No,
when
no,
you're
go ahead. Go ahead.
basically you're in a bull market, you're making the already hard decision that most funds don't do, which is to exit, whether that be OTC, liquid reassignments, things like that. It's a hard process. It's annoying. It takes a long time. If you do go through that process to exit, now you obviously have tax liabilities to your LPs, right? You sold an asset, you have a gain. A lot of funds, or some funds, will say, hey, you know what? We're doing great. Let's reinvest that capital. So now we not only have a tax liability that we may or may not be able to pay out to LPs. Some have to, some don't. Um, but they're also investing at the height of valuations in a bubblish market, which means not only do you owe money to your LPs, but now you're chasing a trend when you should be doing the opposite. So, yeah, it's kind of tangential to what Santi's saying, but I think that there shouldn't be reinvesting in funds. I think funds should just aggressively distribute in bull markets. And I think right now is the absolute perfect time to be aggressively investing in private deals or liquid opportunities that are great, because you're not going to invest at these valuations or these non-tourist teams in a bull market. You have to do it now, and you have to wait a couple of years.
Yeah. So my view on this, based on the experience that I've had over the years, is that the correct architecture is that you separate out the types of investments. So you have venture vehicle that invests venture style, liquidates sometime between, TGE and TGE plus 180 days. We've done some analysis internally that has shown that, a basket of any number of L1s that have come out underperform ETH beyond 180-day timeline on the aggregate. And that should be different than your liquid book. And you get all these venture funds that will liquidate a win, hold it then in ETH or in Bitcoin, and then hold it to the term of 7, plus two, or whatever the length of the fund is. And then, their idea there is that they're going to catch the 20 on whatever appreciation in Bitcoin and ETH they have. I think that is, that is not the mandate of the early stage venture vehicle, to then take a win in year 3 and hold Bitcoin for another 5 years. And you should prioritize distributing, because you have such high beta in this market. The volatility is so expressive. Take the wins where you can. And I can tell you that it feels really good once you get above a 2 DPI, right? Then you kind of made it.
You're playing with house money.
For your
the challenge with that,
investors,
Ryan, is
right?
I don't disagree with you. I actually have looked at that as well in terms of the trading. The issue, though, is that your vesting schedule is, when you say actually practically liquidate 180 days, you can't do that practically unless you're selling. Means, I guess you could
OTC.
Hedge at OTC. You could, do some combination of perps and whatnot.
Take shorts.
To lock in.
Yep.
Yeah. You could do a number of strategies. Okay. Yeah. I just wanted to clarify that, because typically the vesting schedule is, you gotta, if you're not doing that, and some funds are not sophisticated enough to do that, or it's not practically possible, it takes 2 years to actually exit the position.
Yeah, look, we invested early, we backed you, we loved you, we helped you build, but hey, look, I want to exit my entire position within 180 days. Like, how do
Well,
you
maybe not.
maintain the
Maybe
relationship
not.
with?
Yeah, you're not saying I want to exit my entire position in 180 days. What I'm saying is that objectively, the data shows that in infrastructure investments, the optimal exit window is within 180 days. On the aggregate, we've looked at, I think, 24 examples of sort of the ETH killer generation, and now looking at generation 3. And I'm not saying that that's what you do. I'm just saying that like the data shows that that's the optimal investment strategy. And like you do then have to be pragmatic about, yeah, we'll take principal off the table, take principal plus X off the table because we're pragmatic entrepreneurs. And often what I'll say is because we're the ones sitting liquid, when you bottom out in year 3, we're the ones back buying, right? And that's also useful for an entrepreneur that like we won't totally get out of it, but we will be pragmatic about cash management.
Yeah. I think there's two things there, which is it's the hardest thing, one of the hardest things you do, right? But you have to focus on risk management. One, what's the probability of something that's already up 50x, 100x in your book to do another that? And in venture, it's a power law. So you need one or two. If you don't have one or two or three 100x, you're probably not going to make it to that 2 DPI. So you go back to the founder and say, I need to take chips off the table. It's become such a large position of the portfolio. It's proper risk management. And I'm going to use that capital to reinvest in folks as I did with you when no one wanted to give you money. And I need to find those, or sometimes a combination of that plus investing in the ecosystem in startups that are building on top of, if it's an infrastructure investment. I generally tend to find that the best founders have no problem with that. They're like, hey, just do it in a graceful manner, find a right home for that position. And there's ways to do that. Difficult more now because there's very little liquidity, but the OTC market's thriving. I mean, it's actually booming right now. And so there's ways to execute these things. And so at the end of the day, I think the strongest founders most of the time don't react like negatively to that. They understand that there's time to exit a position. And that doesn't mean you're not going to continue to help them, by the way. It's like, it's capital, but my help, I'm still here.
The other thing that I have often done over the years as well is do buy-side OTC with the founder, pre-launch often. So like pre-launch, they want some liquidity, buy a house, so on and so forth. I'll do buy-side on that. And then like, you have a transparent relationship with the founder where like, hey, you're being real about your own like portfolio balancing and realizing the volatility of this. So me 6 or 12 months later, also being real with myself and with my investors about this is just authentic, right? And most of these founders, understand that. And because now we've had enough years and enough stories of like, the billionaire founder that wrote back to nothing, or the guy who like just never even looked at a pie chart of their net worth to realize that 99.9% of their wealth was in a locked up token, that people are more pragmatic about that in the space. Like if you look around the space, the top founders that people really respect from Vitalik all the way down have been pragmatically taking chips off the table the whole way up.
Yeah. I think that's a hugely positive signal. I mean, it's less, they're going to be more focused, having taken chips off the table, and it's fairly common in venture too. I mean, you see some recent IPOs, and it's fairly common for founders to take chips. They should. I mean, I would encourage them all day long. If a founder comes to me and says, I want to take chips off the table, I say, yeah, of course. You're going to be more motivated to then continue to build equity value on the position that you have left. Now, different story. If it comes to me as secondary and says wants to sell 90% of the book, you're like, well, what's wrong here? But
yeah, I'm with you guys on founders exiting to get some capital to not have to worry about bills and stuff. The one tangential thing I do not like from founders, maybe this is a little spicier because it's happened over the past couple of months, is founders who realize that their projects aren't going well and decide to make a last minute pivot instead of returning capital to venture funds. That's something that I feel very strongly
you're
about.
touching
Is
a
just
nerve.
something
mean
that
Touching a nerve
I came here
right
spicy.
Oh,
I came here
you
spicy.
delivered on the spice. 30%
You-
of the what is it? 30% of your portfolio companies are in that state where you're like, guys, like stop going to conferences, keep like return the money.
Well, it's just the thing that I don't understand is like you spend a really long time diligencing a founder on a specific vertical, right? And you take a
now.
lot of risk with other people's money or your own money to back somebody and their vision. And then they come to you 6 months later, a year later, 18 months later, and they say, hey, you know what? Things aren't going well. We decided we're going to do this totally new thing and we figured it out in the last 2 weeks. Like the thought process just doesn't really make a lot of sense. And I frequently tell people, like, I mean, obviously, legally, most funds, again, don't really have a say, right? If you're investing in a safe or a token or something, you don't have any real investor rights to block or make any real decisions unless you're doing your own docs and legitimate diligence, which, isn't always the case with an early stage investment on the documentation side. But I always tell them, like, if it's not going well, return capital, maintain your brand and your reputation, and we're happy to back the next thing you do and go through the normal diligence process. But it's just hard to get excited about a pivot when it has nothing to do with your original investment.
And that is exactly the thing. So if we gave you capital at the peak and you have call 40% left over of the capital and you return the capital, we're actually up ETH. If we could be up ETH against say 21 or whatever it is, that's a hug it out. That's a next time you come through the door, we're probably writing you a check. That's a really positive, high integrity situation. Whereas too many founders look at this as their personal trust funds that they just want to bleed to zero. But then what they don't understand is that is your last kick at the can ever at that. So you better have enough money to live on forever because no one's ever writing you a check for anything ever again. Not a popsicle stand, not a crypto project, not anything. And, one of the real issues that we face in the space is especially when it's a token driven investment, there's a complete dearth of legal recourse, right? The number of foundations sitting on untold billions of dollars that have delivered no value whatsoever. And these Swiss Stiftungs or Cayman foundations have just turned into glorified trust vehicles for the founders and the board is egregious. I have really wanted somebody to do an activist fund going and pursuing these treasuries. Yeah,
Jeff Torman from
Arca,
Market
they
Trad.
did this to some extent, but not executed as an activist should. I think it was I have my reservations.
And the problem is there isn't enough legal recourse. You don't have the same rights that you have as a shareholder, and so you can't.
Ryan, how big are the treasuries? How much are you talking?
Block One, Golem, like these are $1 billion plus. I mean, so Block One, I think, has more Bitcoin than MicroStrategy Sailor. Like,
and that's including the $1 billion that's lost from the sale, right? I think $1 billion was
$4 billion.
Lost or
It's
used?
a $4 billion unregulated sale of securities.
But I think they ended up only having access to $3 billion. I have to check. Something was weird there with the sale.
Rounding error. Nonetheless, we did an analysis on this because we thought about getting activist in 2020, and and I had participated in the conversations that led to the DigixDAO wind down, and that was just like you go to the founders and you're like, look, you're the largest token holder. If you return this treasury, which is a multiple of your token, you're actually the one who benefits the most from this.
Right.
And Sean was really pragmatic about that and he did it. But we then went and had 6 other conversations, and all these guys would dance around to not admit that this is just a trust fund to pay them out forever.
And you can probably monitor this on chain, but they're probably borrowing against that, right? To diversify. They're not selling just because optically they still hold that, but they probably have a ton of
they're all just buying T-bills right now.
Yeah.
The number of T-bills held by Swiss Stiftungs right now would boggle the mind.
Yeah.
Tens of billions of dollars.
Yeah. I mean,
get
a hold of this, and I have the number now. Block One has over 200,000 Bitcoin. MicroStrategy, given their latest purchase, they bought 4,400 Bitcoin this week.
Yeah, they have 167,000.
They have 158,000.
Yeah.
So
Are we sure we want them returning that capital though? Like, are we sure we want that Bitcoin and ETH sell pressure? The,
I mean, this is
Well, yeah.
also goes back to
Let
Mt.
price
Gox.
discovery.
Yeah, let it rip. I mean, get
Right.
the band-aid
Yeah.
out. And at the end of the day, I mean, this is going to be a conversation also for Mt. Gox, if and when that happens, all the other different creditors. And also, what's another big one? I mean, you have obviously FTX
FTX.
now.
FTX on the horizon, and
And
those are some big,
the
big
conversion
ones.
of grayscale products, GBTC, ETHE. Like at the end of the day, I mean, if you have an ET like that ultimately, because in the market, I'm always a proponent. You just it's better to have more transparent and efficient price discovery.
Yeah, 100%.
Like, pe- if you think that people are not looking at these things and doing some structure around it to hedge that risk, you don't understand markets well enough, because sophisticated players are looking at that and already, it's already kind of to some extent priced in, and people are doing that on the margin. So it's really, in my mind, a nothing burger. Like, just let's distribute it, get it out in the open market, and let that, run its course.
Yeah,
yeah.
I would say that in some cases, like FTX, it's probably overpriced in, where like people are like, all this Solana is going to hit the market, and it's like actually not, because Sam was on a 7-year vest with that Solana, so it's going to be a long bleed of shipping all that SOL out the door. Whereas other things are more, um, just more unknown. It could hit the market all at once. Whether you had legislation that allowed people to go after some of these egregious foundations that have delivered no value, or whether you have, you know, something like Binance completely blow up and get treated like, like tornado cash. So it's sanctioned, not just, in a legal process, and everybody's got to get out the door all at once. There are most of the time things are priced in, but there are some events that could be really dramatic for the space as well.
I think that's a good segue to Binance. Ryan, you want to take that one away?
So, there's a lot of discussion in the space right now. Um, there's been a bunch of tweets. Adam Cochran put one out yesterday of speculation of just how deep this goes.
Are you done
I
reading that
think.
thread, Ryan? They take me like a couple hours.
Well, here's the thing: that thread paired with an immediate announcement of the unwinding of the Russian relationships by Binance seemed to me like an admission of guilt, a public admission of guilt. And we know that the Wagner group was using Binance for payment now. Like, that's not a controversial thing. So the depths of where this goes is like even more shocking than I think any of us understood. We have to remember that 6 months ago, Binance represented about 50% of the like exchange off chain volume, and has their tentacles in probably 1,000 startups in the space. Like, this is not FTX, this is not Mt. Gox. This is something that is like much, much more significant, if true. And I wanted to kind of unpack with you guys of what are your thoughts on what the implication is if this is true? Because for me, it's like it could be something that we have never seen before, and we've seen a lot, in this space, obviously.
Yeah, I did a podcast with Travis recently on Binance. My TLDR, it's not super long or
This is
descriptive.
Travis Kling from Ikigai, who lost all his money on FTX. For
Yeah,
context.
exactly. So he's been through this sadly, and clearly knows what to look for and the signs. He has a great thread, like bulleting out every single thing that Binance has done that's a little sus, and it's solid. My take is that I think CZ is too rich, and I think Binance makes too much money for there to be any fraud. I think it's just killing the golden goose on a scale that doesn't make any sense to me. As for like the regulatory KYC, OFAC violation, stuff like that, I think, yeah, they probably definitely get hit for stuff like that. Everybody and their mother was on Binance the last couple of years until recently. But I don't know. I think that anything less than a full I think if there's no fraud, the market may actually rally because I think people are pricing in a pretty disastrous unwind, and I don't think that's the case. But I know I might be the outlier here.
Santi, any
Uh,
implications that you draw in a
I'm not going to comment
forward-looking?
on the rumors, which I think a lot of it is at this point that I think there is a bit of a dynamic where people want to find the next FTX. Now, I think we should always be incredibly skeptical and curious at the same time. Like in crypto, it will always serve you well to be, yes, we're all optimists, but you have to remain highly skeptical. That's just having those two, as I think served me well, I think will serve anyone well. And you should always be wary of centralized institutions. I mean, that's why we're here.
Yeah.
And so I don't want to offer anything because I'm not close to it. I don't have a strong view. I am cautious, as I am cautious with any centralized party, because as I am cautious with the financial like system as a whole, like it is not transparent.
All right,
And
here's a
so
question
like
for you,
it's
Santi.
more interesting to think about what will happen, to your point, Ryan, if
Yeah.
this goes down. Yeah, it is. It's a huge reset, like way more than FTX.
All right, here's a question. How much of the Binance bullets that Travis shared, these dozens of things that they've done wrong, or supposedly done wrong, how much of that is a hyper growth company, which has scaled to the largest crypto company we have in a matter of years, versus actual fraud? Like every company has growing pains, whether you're a startup or whether you are the literal largest company in crypto. So I'm not sure how much of it is actual deathly issues or more so a major company scaling in a new space that can't be domiciled in the US. Like, do you know where I'm going with that? Or
I
Yeah.
mean,
No, I mean, I think that's very valid, right? That like, and also by some metrics, until until ChatGPT and OpenAI, Binance was the fastest growing company ever, right? And so clearly they were growing in an uncontrolled fashion, and some of these things were probably more carelessness rather than maliciousness. However, there are a number of data points that indicate that carelessness descended into recklessness. Like if you're providing payment services directly and emailing back and forth from the Wagner Group, who are like slaughtering Africans all over the continent, that's a moment where you really got to look yourself in the mirror and ask yourself what you're doing here. And if you need more money or if you need this type of business, the fact that they, 2 days after a bunch of rumored tweets, publicly announced unwinding of their Russian operations, for me looked like admission of guilt. That was a bad look. They probably should have timed the PR on that a little bit better. Um, but I think the important thing is anybody listening here, if you have your money on Binance and you don't have a hardware wallet, you don't belong in the space. Get out. Shut it down, sell it, get it. Right. You cannot be like, you can be using Binance. There's a lot of cool tools there and it's an interesting product. But if you're storing your funds capital, your LP's capital on Binance in this moment, considering the range of rumors circulating, I would
well,
question
that's
the
negligent.
competency of that. Yeah, I would
That's being
question.
negligent.
Again, that's reckless, right?
I mean, I totally agree with you. Like, I think that you just, it's like you don't want to be a turkey, a Talib turkey. Like, if there's a greater than X%, if there's a great thing that someone said while FTX was going down, says, if there's a rumor, act quickly, then think. And acting quickly here is not selling everything. It's just, there's an alternative. Get a hardware wallet, store it there, and then figure out how all these things shape out. You're like, you know what I mean? Like the risk is just asymmetric, and it is, you never want to
Yeah,
do anything that puts you out of business. Storing everything, all your crypto in any exchange or any single hardware wallet is negligent. Like
yeah,
have the Horcrux model. As a fan of Harry Potter that I am, segregate into hundreds of wallets. It doesn't cost anything to set up a safe, like a Gnosis safe, multi-sig, sign 2 out of 3. It's free,
yeah.
folks. No, go get a ledger at $70.
A last item that I would say on this is I would say Travis's tweet storm or bullet points, along with a bunch of other people who got really really badly hurt in the FTX debacle, could possibly show a glimpse into what American politicians are thinking. You see all these people wanting to point at Binance and hurt Binance. I would guess the hundreds of politicians that took money from Sam Bankman-Fried probably told him in their last conversation, "Don't worry, CZ is going down too." And it feels like there's a vendetta that anybody who is really badly hurt in that FTX fiasco, in some way, shape, or form, blames Binance, and he is just, CZ at this point has just made too many enemies with the brazen, very aggressive, some would say arrogant approach that he took in the days following the FTX collapse. And so it would not surprise me if behind closed doors in America, and I don't have any privileged information on this, I'm just speculating, but it would not surprise me if high-level politicians are looking at this from a vendetta perspective, especially those on the Democrat side of the aisle.
Tommy, you obviously are really close. You interviewed Travis, and I'm curious what you think in terms of the outcome here. Like, there will be some enforcement action. I mean, there's just a body of evidence. What I've seen is there probably was some wrongdoing, particularly because the rules are not set in place. So when the rules are not set, then they can, it's difficult to, but there are some things that I think are pretty damning in that DOJ. Like, when the DOJ brings an action against you, it's different than the SEC. Like the DOJ action is far meatier.
Yeah.
And
You don't fuck with the DOJ.
Like when the DOJ comes to you and knocking on the door, it's because they have a body of evidence. It's not like, hey, we're probing, we want information. It's like, no, we know you're doing something wrong. Like, just there's an action. So my point to you is, do you think it's a settlement, a huge, huge fine? Does that put Binance at risk of insolvency? Ryan, maybe that's your point. Maybe that's a way to take them down. Or do they? I mean, they're already out of the U.S. pretty much. I mean, volume is zero. All the execs have left. So they're out of the U.S. mostly. So how do you think about like the second, third order effects here? What's the viability of Binance going forward?
I think, Ryan, you might have a better answer than me here.
Oh, come on.
I think the problem is, like, I think it's either two extremes, right? I think it's either they're like, and one of the DOJ press release, not a press release, but on a news report, I think somewhere along the lines it mentioned that either the DOJ or the SEC was worried about the solvency of Binance if they were to issue something that would cause a bank run, right? Which kind of begs the question, like, one, is that report accurate? But two, why would that ever happen? If you have all the assets, then there's no possibility of that happening, right? Because everyone could withdraw. So either they know something that's amiss or they don't. So I think it's either extreme bad case scenario where there is some sort of hole or some sort of fraud, which I really don't understand how there could be unless CZ is funneling money out to support BNB price or something like that. Or there's, KYC OFAC violations, which I don't know what the penalty for that is, in some sort of settlement. And honestly, I think people in the US have a fantastic alternative through Coinbase and Kraken. I mean, so I think people will be pretty much okay. Like, I don't know if you guys saw today, but Coinbase is on Capitol Hill with little beer cans of cold brew with stand with crypto, and it's incredible marketing. Like, they're doing all the lobbying super legitimate.
Finally going on the offense.
Yeah, they're going on the offense, but they're doing it in a super clean, long-term view way, and it's really nice to see.
Yeah. One thing I would say is that the concerns about Binance's solvency are definitely totally unfounded. Dean will shoot me for saying this, but because we've been analyzing NEV in the space for now a couple of years, we approximately know how much CZ has made in NEV on his own chain, and it's an ungodly amount of money. It is a staggering sum of capital. So he's well capitalized. He's fully
Isn't
capable.
He like the largest or one of the largest
solvency.
like top 5 Bitcoin holders?
As well, for sure. I mean, I don't know that like empirically, but we know we've been able to reason through how much money he's made in MEV, and that's only one of his income streams, and it's a lot of money.
Where is he making the
um,
MEV from, Brian? Like which chains, which
well, I mean,
operations?
like Binance, because Binance is effectively POA, right? And I would assume that he probably knows a decent number of the validators, and maybe is a validator himself. There's a unique advantage in MEV on Binance that somebody in that power position would hold. Um, that's a that's a whole other topic to unpack. Like I personally would think that the front running your own centralized exchange is maybe not even as egregious as MEV in your own chain. MEV in your own chain is like what the actual fuck, in my view. And I'm not saying that it's him, but like our analytics show that there's certainly a big dog whale in the BSC chain that has made an unfathomable amount of money over the last 4 years.
That actually is so messed up because you convince people to come to your chain because of your exchange and your reach, and then you turn around and you MEV the users that you convinced to bring over. Like that
Oh,
is
as Dean says, you're just cucking them, right? You're just cucking all these users.
Santi, you brought a good third topic idea to discuss kind of things that are flying under the radar a bit. Things that are like overlooked, CK,
Mhm.
intense, investing. Where do you want to start with there?
Yeah, well, look, I mean, I think it's this general idea. Like, I'm of the mind that, look, irrespective of market cycles, like you can be in a raging bull and you can find gems. You could be in a raging, like you can be in a terrible bear and you could do terrible investments. Like there are some rounds right now that are raising a ton of money at pretty high valuations. And I'm a very much ascribed to the view of Howard Marks here, founder of Oak Tree, says price is really the everything. And that's where people really miss the mark, right? You could say, oh, Ethereum is like, is the best, it has the most developer mind share. It has all this ecosystem, but what about the price? 42 is different than one. It's hard though for an asset class like crypto to think about, well, how do you value these things? How do you value a meme and attention versus, at the end, but also there's a ton of data that is produced by these blockchains, which are data rich. So it's very interesting because you could do fundamental analysis, like Maker as an example. You could do fundamental analysis of Maker. You'd have done it 3 years ago and said, wow, they are spitting out cash flow. It's trading at like sub 10 PE, which is distressed. Um, it is an early stage company with a ton of potential, you could argue, if you believe in crypto, and it is profitable. Like if you were gone down Silicon Valley, say you're Rune, you have a pitch deck, and the pitch deck doesn't have anything. Instead of Control F blockchain and crypto and swap it with fintech. Rune could have gone to Silicon Valley and says, "Hey, look, we're a 5-6 year old startup. We have X amount of users. These are our metrics. Super transparent dashboard. This is a growing number of loans. This is the cash flow that we're getting. We're 5-6 years into the journey, and we're valued at X, and we're earning Y." Like immediately, he would have. That is a unicorn. Like just does not exist. Like, and so, but of course, we're talking about crypto, so that's uninvestable. But yeah, crypto markets behave really strangely, right? I mean, it's sort of like, can you be patient? Because at the end of the day, I do believe fundamentals show up. And when you think about stuff that will endure the test of time, like legacy DeFi is incredibly interesting to me because these are protocols that have withstood a very adversarial environment. DeFi has been in a bear market, like relative to ETH. Every DeFi protocol chart looks like crap, and it looked like crap even before rates started making any moves. And so the question is, when's that going to turn, and if it's going to turn? And so, what are the catalysts? I think you need to understand like what is the catalyst, because if there are no immediate catalysts, just hold ETH, candidly. Like, and that's always a default. Or go to treasuries in this environment. So, a bit of a ramble. I do think that like DeFi as a category is overlooked, and I think it's here to stay. I think it has a lot of staying power, and also Lindy. To then, the question really is, what's the metric here? What's the catalyst? TVL? Is it going to be another L2? Is it going to be another flavor of stable coins? Like, what is it going to take for DeFi to come back in the limelight? And I don't really know.
What are the metrics that you're using to drive signal on that? Like, something
Yeah.
that we talk about is TVL to FTV, but is FTV the correct metric, or is it, like 5-year token inflation divided or multiplied by value? Um, how are you looking through metrics that drive, in a Howard Marks um,
Mm.
sort of school of thought, having these key metrics that drive indicators of value, taking a value investing approach to crypto for the
Mm.
first time.
Oh, that's a great question. I mean, Tommy, I don't know if you want to jump in here, but for instance, I'll start with things that I've seen investors do probably wrong, and we were talking about fully diluted versus circulating. I
Mhm.
think just looking at one or the other or the two can is a bit misleading at times. I think you need to understand what the emission schedule looks like, and it's fairly common. Probably look at what is one like emissions year 1 year out, 2 year out, 3 years out, 10 years out, 5 years out, and then think about okay, one of them might have like an emissions curve that looks like that, which is in 5 years you're going to be reaching your total circulating supply, and so that has a lot of pressure in the market, right? Those tokens coming live, maybe investors unlocking, and the sell pressure might be a good opportunity to then time when you're going to want to build a position if you know people are going to unlock. And the other times you could have dynamic emission schedules, like you're intimately familiar with Filecoin, that are based on some sort of parameters. As the network grows, more tokens get emitted, which it makes sense, right? And it's like up to like 100 years or like 40 years out, right? So at that point, you don't want to be looking at fully diluted, right? Um, you're better off understanding the emission curve, right? And so in isolation, you could look at Filecoin when it launched and the token hit a price where you're like, oh, this is like 0.3% of all world's GDP. That's crazy. In reality, very little tokens there in circulation, and so that's a big mistake, I think. And the other really is you need to understand the type of business model. An exchange like Uniswap, completely different than a money market like Compound and Aave and Maker. Totally different metrics, right? On the money market side, what's the most important thing? How many loans are being emitted, right? What's the average duration of the loan? Because the protocol earns fees on that, right? And so, yeah, TVL directionally is very important, right? You want to see that number grow. You also want to see the kind of the turnover of those loans, um, and the kind of the retention of the user, right? Say, what's the average, for the user of that is opening up a loan in Compound, is he also using Aave and Maker? And what is that wallet share, right? If he has like $100 of loans outstanding, or supplying certain assets, like how is that distributed across all the money markets? For an exchange, TVL is not really relevant at all. It's really the utilization, right? Like if you compare Uniswap to practically every other AMM out there, Uniswap is like orders of magnitude just more efficient in that with that capital, meaning the turnover of that, right? There's liquidity pools and the trading volume of that. Like if you have $100 in sort of the liquidity pool, how much of that gets traded on a daily, weekly, monthly basis is vastly superior to any other AMM out there. And so that's really, in my mind, the most important metric, right? And so ultimately a combination of things. You can, I don't want to stop here, but then you can look at all the on-chain analytics of, Maker, for instance, like the popular trade when you saw for selling, you saw like one of some of the largest holders on chain moving the coins to an exchange to liquidate. So, it's super interesting, right? Because you can do fundamental analysis. You also need to have a bet on how big these markets are going to be and in what time frame. Um, is it going to outperform the underlying benchmark, ETH, Bitcoin, treasuries, and then also understand what are other like large holders doing. So, in this asset class, you guys have been around for a while, but you're like a VC, but you also can be a hedge fund analyst and high frequency trader if you can. And I don't, it's just intellectually super stimulating to kind of be able to do all of that.
Yeah, it kind of comes together in this sort of emerging idea that I think we're all playing around with, and a whole bunch of people are circling around in the space right now, of this idea of liquid venture, right? That the investment principles have like venture like components to it. Um, do we believe in the team behind it? Do we believe in like really uncommon value that this can unlock. But because crypto is liquid effectively from like the Series A, to compare it to traditional venture, you can take a better risk adjusted approach, where again you can take some capital off the table or dial back into something when it's getting to a point where purely on a PE basis it's making sense. And that's one of the driving forces that I think we spend every day asking ourselves in early stage products outside of just core ETH is, what is the cash flow the thing is throwing off? And then do they have the courage to accrue the cash flow to the token holders? So for example, like a DYDX, throws off really, really great cash. It's trading at a 6.5 times earnings, but they don't have, for one reason or another, they have not decided to accrue that value to the token holders. That combined with your previous point of massive jumps in inflation overnight. I think we're like 2 months out from just a huge inflation spike, has left that, from an outside perspective, most people would say undervalued. Something trading at 6.5 times like free cash flow, with all the volume that it has, all the great developers it has, and Tony is a phenomenal CEO, so on and so forth. But then there are these other inputs that you have to consider, like, hey, there's about to be a massive spike, and um, and and so on and so forth. But I think it's just really, I'm really excited about the moment at hand to be able to finally bring value investing principles to crypto. That it's not just like pie in the sky,
No.
if it could be some percentage of the total value of gold, then it's worth, $100 billion, $1 trillion. That we can now actually look at these things from a cash flow perspective. And Maker is a great example of one of the first things you could look at from a cash flow perspective. And DeFi, I think, in a year or two, maybe three tops, all DeFi will be priced based on cash flows. Once we're able to actually accrue the value to the token holders, and we can get away from this, like, oh, it's not a security, then it'll just be priced on cash flows.
Tommy, let me ask you a question on this point, because this is something that it gets commonly debated, like Sushi versus Uni. One was distributing the earnings back to stakeholders, like people that were staking Sushi. Uni is not, right? It could be voted in, but it's not. And so for better or for worse, the kind of the regulatory environment and lack of clarity has handicapped our ability to design token structures that make sense. I mean, these protocols spit out cash, but there's also this kind of debate, like, what do you do with that cash? Like, it's very uncommon for an early stage venture project to be spitting out cash. And the question is, should you reinvest that in the business? What does that reinvesting actually mean as a protocol? What is that, like DYDX and Uniswap, doing without Treasury, that admin contract? Or do you distribute it back to stakeholders if and when you have clarity? So I don't know what the right answer is. I think it depends, but I'm curious to get your thoughts on that, and if it factors into your investment decisions.
Just to build on that for you, Tommy, how do you look at it when, in the case of, say, a DYDX and a Uniswap, they've done massive successive rounds of equity raises and token raises, and they have two sets of constituents who, by the way, are not the same people? And how do they, like, is it a regulatory thing, or is it
sometimes there's not?
Or is it just a question of what constituent they're trying to appease? Right.
Yeah. Disclosure, we're investors in DYDX, and I just had Antonio on the podcast this week, and it's ridiculous. They've done $1 trillion in volume, right? Like it's crazy. And his
Since
confidence,
inception?
Since inception, and his confidence as a founder is hard to beat. He is really dedicated and just really dialed in. As for the value flows, I think Sushi added the fee as a differentiator versus Uniswap during the vampire attack, just something that they can do differently that Uniswap didn't have. So I'm not sure if, we could make like a long-term view of that. I also think DYDX is moving to a Cosmos chain for obvious reasons, to control their stack. And they have a use case where they need to do that and edit a lot of the technicals. But I also think it's pretty clearly an unspoken regulatory reason. Like, let's drive actual value to the token, because you'll need it for nodes, you'll need it for other reasons, and it's easier for the community to make changes. As for the breakup between equity and tokens, Ryan, to answer your question, I don't think there's any good way to do it. I think it has to be hotly debated and somewhat decided before you make the investment, right? Because if you're going to invest in a $25 million token that has an equity component and 50% of the value is flowing to the equity, you're not investing at 25 mil in the token. You're investing at 50 mil in the token, I think, in my mind, or even
There's
worse.
usually a
right?
2-to-1 relationship, right?
2-to-1, but if
Something.
that makes it even worse, because now if you're 2-to-1, you're 25 mil equity, 50 mil token, and now half the value flow flowing to the equity. Now you're at 100 mil on the token in my mind on the valuation. So it gets even worse there. We're running low on time, guys. What should we pivot to for our last topic?
Well, Tommy, you've been under in terms of the audio. Ryan and I have been talking a lot. I know you want
It's
to
good,
talk
though.
about. No, well, yeah, but you have a lot. I'd love for you to share your thoughts on zero knowledge proofs, because this is a topic, going back to the opening, it is hot in these conferences. You have multiple different flavors. As far as I can remember, zero knowledge proofs have been like one of the holy grails of crypto. It offers so much potential. It's been slow though. And this might be one of the things that gets overlooked, like the amount of progress that is now being made in an exponential manner. And these unlocks in terms of the tech, the cost, the viability of it, I think it's come a long way. And it's something that perhaps crypto as a whole is a bit skeptic. Like if you've been around for 7 years, like, don't talk to me about homomorphic encryption, zero knowledge proofs, and there's other categories, right? That just are, feels like folks are fatigued. But let's talk about that, and I want you to give us your take.
Yeah.
Why don't you run through that for us, Tommy, with the sort of lens of explain to people why zero knowledge, which has not had commercial success in the space and crude value, why is that changing now?
Yeah, it's a good question. I'll preface it with I'm not a developer or ZK coder. There's only a couple in the world that actually really understand the math at play here, like the Ellies of Starkwares of the world. But the way that my mental model for ZK is that it is the end game technology for scalability and privacy, right? Like being able to use math in a way where you can do massive amounts of transactions and/or privacy and have privacy and roll that down to an L1 or a settlement layer without any guesses to its accuracy, right? It's all proven through math, which is different from optimistic rollups, right? Where you have to hope and you do a fraud proof if not, is pretty much the end game for me, I think. I think it is for everybody, right? So the way I'm breaking it down is into three buckets. You have ZK EVMs, ZK VMs, and full-fledged standalone layer one ZK blockchains, right? A ZK EVM is something that's very compatible with Ethereum, right? You have the Polygons of the world, Scrolls, Lineas through consensus, ZK Sync, Kakarots, those that work directly with the EVM. It's easy to bring users, easy to bring liquidity, and you could work with it, right? But you're limited, right? You can't do as much because you're limited by the EVM, things like that. Then you have things like ZK VMs, things that are like purpose built for proving proofs, right? Like Starkware, the stuff that's 100 to 1,000 times more efficient at proving proofs since the language is purpose built for doing that, right? You don't have the constraints of the EVM. That's like Aztec for privacy or like Starkware for scalability. And you can do that. And then you have layer one standalone blockchains like Aleo and Mina and things like that. You lose all the liquidity users in the ecosystem of Ethereum, but you could do hopefully much more unique things. So that's the breakdown where I'm at right now. And I'm really struggling to figure out why most Alt L1 chains will survive the wrath of the best magic math in the world, with the best ecosystem in the world being Ethereum right now. Obviously, I love the Solanas of the world. Like that's the best bet on the fastest shared global state, bar none. Like that's the goal, right? But yeah, I'm struggling with how alt ecosystems will survive as ZK Tech comes online, and we're a venture fund. We have to invest 2 to 5 years out, so it's tough to not get around that.
Look, I think it's a great point. Let me ask you a question. Say that one of these like deeply research based kind of like startups unlocks something huge in the zero knowledge space. What is stopping an existing L2 to fork that and deploy it because they have the distribution scale? And like, look, when I invested in Scroll, it was like, they were the pioneers really in ZK VM. And then but I'm also an investor in like Arbitrum. And I would have guessed, like, I'm talking here, but if I'm in the Arbitrum camp, I'm saying, okay, I've already raised all this money. I clearly believe optimistic rollups are, in the near to medium term, really viable to fill a lot of the demand. And that's good enough. And if for whatever reason a team like Scroll or someone else really develops something that can unlock, like, at one point you're going to reach a limitation in terms of optimistic world capacity, right? Maybe ZK, tech allows for the next wave, but maybe that's 7-10 years out. What's stopping Arbitrum from just using that tech and integrating it? And, like, they have the distribution. Like, I'm just kind of how you think. The question really is how you think about, like, the moat here. If someone develops something, like, gets forked and gets implemented, and Optimism could just deploy their own, right? Like, I'm just kind of
Yeah.
curious.
No, it's a good question. I don't have a great answer on the optimistic side. I actually have Steven and Ed from Arbitrum coming on the pod next week to
Nice.
discuss the counter view. But the thing that I kind of laugh at is, and this is like an irrational take on my part, but we're human, we're allowed to have two sets of beliefs here. I love things like Base because you have the might of Coinbase, 150 million or 150 billion in liquidity and 100 million users, and you have zero fraud proofs, right? Like, you're optimistic, you don't even have fraud proofs. But then you have something like ZK with the Starkware where you don't even need those things because everything is always proven by math, right? So it is kind of a weird dichotomy. As for, can other projects copy ZK tech? Sure, I think they can, but two things. I think, one, after you build an ecosystem, it's hard. Two, I don't think it's easy to copy ZK. It's really, really, really hard math and code,
There's
and
like
I
10
don't think it'll
people
be
in the
easy.
world that can do this stuff.
Yeah,
Maybe
so
less.
copying it'll be really, really hard. And honestly, I think eventually the tech will commoditize, to what Ryan said earlier on other things, right? And eventually it'll just become a biz dev game and a community game, and whoever wins that is going to have already started.
I mean, sort of Polygon, or what do they rebrand to? Is like already kind of executed on the strategy, right? They acquired Hermes. Like, what is it?
Ryan knows that
Jordy's
well.
actually,
Jordy.
Jordy's in
He's one of the smartest guys.
our office.
Yeah.
And one of those 10,
Yeah.
one of those 10 people that can actually do this. But that's a really interesting thing. I look at this example really closely because we share an office with Jordy, and the tech is very impressive. And I think this is true broadly of a number of things with Polygon. But I would guess that they're disappointed in the amount of users and traction that the network has today, which causes me, as an investor in this, to question, like, is it that people don't care about it right now? Because it's got, like, literally, single digit thousands transactions per day on the CKEVM. And, or is it just that, like, we haven't hit the knee of the curve and it's coming because, some catalyst will bring it. And then what is that catalyst? And that's a question I suppose I have for both of you, is it a UI thing? Is it people don't actually care about privacy in the current context? Or is it something else that has caused things like ZKEVM to not have the traction that we all expected and hoped for?
That's a loaded question, my friend. And I think I always go back to the example of what happened with Binance Chain when it launched. PancakeSwap in the first month acquired more users and was seeing more transactions than Uniswap. At that moment in time, you would have said and looked at that, yeah, no one really cares about security. People are just chasing the next farm. And this is when, DeFi was kind of hot. But now the staying power, you got to look at these not in isolation, not in a 3-month window, but like over multiple years. At the end of the day, everyone that is in crypto today is a beta tester, beta user, given the level of risks and the number of users. Like, it's a very small crowd that uses these things. I think I wouldn't take too much stock that it doesn't care. I do think that the best tech will win, not just the best marketer for this type of technology. Like, when things break in crypto, it's not like when things break in Web 2. Like it is fundamentally, like, you don't mess around with crypto. You know what I mean? Like, there's no one to call. There's no 1-800 number. You can't peel back stuff. And if you do, like, it compromises trust. Like, ultimately, you want to be building crypto products because security is the most important thing. Security is a very broad, and I think it can encompass many things and is different for folks. But fundamentally, there's a reason why Ethereum is Ethereum where it is today, and Bitcoin, and there's this idea of Lindy effect. And I ultimately think that like when you do hit and there's a killer game, there's a killer application, which we haven't really seen yet, then you have to think about, well, what's that flow going to be? Where's that wallet? Where's that exchange or aggregator, if you will, that might come from Web 2, right? Because the retail demand is going to come and they're going to go through an aggregator, I think. And ultimately, that aggregator will, whether it's PayPal, Visa, whoever it is, JP Morgan, will fundamentally care about security and understand it well. And that's where I think they will evaluate these L2s, they will evaluate these L1s and say, yeah, we're going to make the decision to push our users to this particular chain because it's the most secure. And security begets liquidity, and that, increases security, I think. And so it's that flywheel that Ethereum is on, maybe Solana, that it will be hard to overlook if you're not as secure as another L2.
Yeah,
It's just too
Santi,
early to tell, right?
I like that framing. Ryan, just to go back to your question originally, like why hasn't this stuff really taken off? I think that I just had Ellie from Starkware on the podcast this week and spoke to him or last week. And one of the things that I thought was super interesting that he brought up was I asked him the question point blank. I said, how do you, as a ZK VM, compete with a ZK EVM, right? Like a Polygon or something, because they have easy to port apps, users, they have liquidity. It's a pretty straightforward question, right? On competition. And he said, look, it's going to be hard, but you just cannot build the stuff that you can on a ZK EVM that you can with the flexibility, the low cost, the speed, and the customizability of what we're doing with Cairo and with ZK VMs. And honestly, it made a lot of sense, but it also pointed to your question on timelines. Why hasn't this stuff taken off? I think it's just really early for really hard tech, right? We've just started to get like mainnets launched. We just started to get languages solidified. Like, I think that the arc of technology is in the ZK favor, but I do think it's quite early.
Yeah, you're right. I mean, ZK EVM only came out in March on Polygon, and so it's far too early to judge. I would challenge the Starkware guys on the computational density of the Stark proof, and it remains. It will create quite the blockchain bloat in its current format, but they're smart guys, and hopefully they continue to work on it. And then, what is this magical thing that you can't do on Ethereum and Polygon that you can magically do on these other things? Like, is there a hard example of something? Because the more and more we look out across the space, the more I think we all see the aggregation of mind share and probably over time of capital consolidating around the ETH and the ETH layer 2 ecosystems, right? And that's why I continue to be a really strong believer in Polygon, because even though ZK EVM doesn't have traction, it's really like once we hit me in the curve on that use case, it's probably Polygon that's in the pole position. But I don't know.
I think it's an interesting thing for our listeners to just go home and just comment. Feel free to comment on how you think and whether it's marketing or tech that will prevail. I think it's quite early. I think we can all agree on that. There's so many risks, and so I think you also have to think about, are you being compensated well enough to take these level of risks? Certainly, a yield of sub 5% on DeFi ain't gonna cut it, folks, because you can just park it in treasuries. But look, I think this has been a fantastic episode. We'll leave it there. I think that we've obviously identified a thing of, in the bear market, things are overlooked more so probably than, well, generally speaking, markets overlook things. They're not efficient, certainly not in early stages crypto. There's so many things that we can continue to talk about. So in the next episode, I would love to just go deeper on things that we think are being overlooked, because I'm of the mind that you can find fantastic opportunities in any market cycle, in any market environment, and it's quite early asset class. And so I think there's so many good things here. Just retail has access to these incredibly young startups, not all of which are good. But the fascinating thing here is data is produced in real time, and you have so many tools at your disposal. and so many people, a lot of it is open source. So you can learn about this stuff, not just with podcasts, but just going on chain and using tools and analytics. So it's just an incredibly exciting asset class. So why don't we just leave it there, folks? As always, a great discussion, Tommy and Ryan.
Awesome time, guys.
Thanks, guys.